Welcome to Finforall by Jupiter. My name is Dipansha Dhingra and today we are going to talk about tax planning for salaried employees. Remember your first paycheck? Everything was great until deductions. That's the part that made you realize how good you had it when your parents paid for everything. Jokes aside, taxes are an integral part of our income because simply put, they support all the services we have. You can't really avoid them, but you can find ways to save some of your money from getting taxed. That's the very essence of tax planning. And for those of us who can't hire accountants right away, it is quite important to know some simple ways for it. At this point, we are well aware of the importance of Section 80C and its subsections. They basically list out a number of activities that help you reduce your taxable income by up to 2 lakh rupees. Today, we will discuss some of the most common instruments that you can start investing in right away. Please note that the assets we will discuss today are absolutely beginner friendly, so get set budgeting. First is of course mutual funds or equity linked savings scheme, or you can call it ELSS. These are called equity linked because they invest most of your corpus in equity like listed shares and bonds. Therefore, when the market goes up, you get massive capital appreciation. This is one of the best tax-saving assets for 4 reasons. First, you can start with just 500 rupees as both SIPs or a lump sum investment. Second, the lock-in period is 3 years, which is the least amongst all items under 80C. Third, you get both capital gains and tax rebate up to 1.5 lakhs. And the fourth one, they help you save up to 46,800 a year in taxes. Just remember that your money will be locked up for 3 years and you won't be able to withdraw it. But on the plus side, the longer you stay invested, the greater your returns will be. Let's do simple math. Suppose you start investing 500 rupees a month into a mutual fund that gives you 10% returns per annum. Let's say you keep investing till the end of the lock-in period, which is 3 years. You would have invested 18,000 rupees and your gain at the end of 3 years would be 20,891 rupees. This is an overall gain of roughly 16.1%. Of course, you'll flourish and get a higher package with each hike. So you will end up investing a lot more than 500 and the gains would be even greater. Every investment app has a calculator that shows you the projected returns for your investments. Do check out yours too. When it comes to mutual funds, it's also important to look at expense ratios and charges you will be paying from your end. Expense ratio is a major deduction from your returns and it covers a variety of things from commissions to exit loan. We have discussed these in detail in another video. There's also a penalty if you miss your SIP installments due to insufficient balance. So do make sure you check not just the gains but the pains too. Some investment platforms help you do away with some of these charges. Investing in mutual funds through Jupiter, for example, provides you India's first ever no penalty SIP. 0 commission charges and 0 investment charges. These cancelled charges can actually help you get up to 1.5% extra returns compared to other mutual funds. Check them out through the link in the description. Moving on to the second asset, which is the National Pension Scheme or the NPS, it is probably the most popular investment scheme for our parents. The good thing about NPS is that every salaried employee is automatically enrolled into the scheme and you can choose to opt out of it. We won't advise it though, because regular savings with the scheme as stable as the NPS are always a yes for your retirement. Usually 10% of your basic salary, not gross salary, is invested by your employer into NPS. The NPS contribution too starts with 500 rupees or a minimum of 1000 rupees in a year. For the past decade, NPS has been giving steady 8 to 10% annualized returns. Like with ELSS, there is a deduction of up to 1.5 lakh rupees to be claimed for NPS, for your contribution as well as for the contribution of the employer. Subsection 80CCD1 covers the self-contribution and 80CCD2 covers the employer's contribution. The NPS matures when you hit 60. But if you want to withdraw beforehand, you have to wait at least 5 years. Again, don't recommend opting out. At maturity, you are to invest at least 40% of the corpus in annuity to pay you a monthly income. The more you invest in annuity, the greater your monthly income would be. The rest can be withdrawn in one go. And the best part is that is completely tax-free. Did you hear that? The sound of a jackpot? Third asset we will discuss is the Public Provident Fund or PPF. Just like the NPS, investors opt for PPF to build a retirement fund. The Government of India guarantees your investments in the fund. The interest rate is set by the government every quarter. The contribution starts at just 100 rupees and you have to invest a minimum of 500 rupees in an entire year. Happy to hear that. That's not even the best part. Public Provident Funds enjoy an exempt and exempt status. Basically, your contribution towards the PPF account, The interest earned and amount at maturity are all tax exempted. The maturity period is 15 years, but you can make partial withdrawals. You can take a loan on your PPF account between the 3rd and 5th year and make partial withdrawals after the 7th year for emergencies only. So there you have it, 3 investment assets you can start today with just 500 rupees. There are a ton of different options to choose from. Some will be more relevant in the later stages of life and career. But today, right away, 500 bucks is enough to start your investment journey. After all, from the tiny acorn grows the mighty oak. Thank you for staying tuned. For more on finance and everything beyond, follow Finforall by Jupiter on YouTube, Instagram and LinkedIn. Don't forget to leave a like and share your views in the comments below.